Stop. Right now your retirement account is changing. A 34-year-old assemblyman just won control of the world's financial capital. His promises? Freeze rent, eliminate bus fares, raise taxes on high earners. The question isn't whether Zohran Mamdani will transform New York. He's already begun. The question is, what does the data actually tell us about what happens next? Let me show you the numbers that both supporters and critics are watching right now. Here's what the data shows. On November 6, 2025, the day after Mamdani's victory, the Real Estate Select Sector ETF was down 7.81% year-to-date. The S&P 500 was up 25.04%. Real estate investors had already begun repositioning before the election. But here's where it gets interesting. The Financial Select Sector ETF, banks and brokers who finance real estate, was up 4.65%. The capital isn't disappearing. It's moving. Texas now employs more financial services workers than New York State. First time in history. J.P. Morgan Chase has 31,500 employees in Texas. Only 28,000 in New York. Between January and August 2025, New York lost 8,400 finance jobs. The same period last year, the city gained 6,400. Each finance job represents roughly $140,000 in annual commercial rent demand. But here's the counterpoint supporters emphasize. Mamdani's coalition argues these job losses preceded his candidacy. They reflect broader remote work trends, not progressive policy. His team points to data showing working-class voter turnout surged. Why? Because affordability has reached crisis levels. The median rent for a one-bedroom in Manhattan hit $4,778 in November. That's a 20% increase in 3 years. Do you see the tension? Markets are pricing in uncertainty while voters are demanding change. Both sides have data supporting their view. History shows us 3 cities that tried similar policies. 3 completely different outcomes. Vienna, 1923. Vienna's Social Democrats imposed luxury taxes, built 60,000 affordable apartments. Critics predicted economic collapse. What actually happened? Construction by private developers fell, yes, but the government became the largest housing provider. Vienna today ranks as the world's most livable city. 62% of residents live in social housing. The model worked long-term, though it took decades to stabilize. Edinburgh, 1997. The perception problem. Scotland gained devolution and housing policy control. Investors panicked. Not because policy changed, but because they didn't know what would change. Commercial real estate values dropped 18%, purely from uncertainty. 4 years later, values recovered completely. Policy clarity returned. Edinburgh's economy never actually declined. Stockholm, 2010. The unintended consequences. Sweden tightened rent controls. Construction plummeted 41% in 5 years. The average wait time for rent-controlled housing today is 9 years. Black market bribes to skip the queue now cost $70,000. The policy achieved affordability on paper, but created scarcity in reality. 3 progressive mandates, 3 completely different results. The pattern, implementation, and local context determine outcomes more than ideology. But here's what matters to you. Which scenario will New York follow? And how does your money get affected? If you're a saver, 73% of Americans with retirement accounts own S&P 500 index funds. Buried inside, real estate companies with heavy New York exposure, down an average of 22% since June. But financial sector funds are up, because they're lending elsewhere. The question is whether you rebalance before the rotation completes. If you're a bondholder, New York issued $1.2 billion in municipal bonds in October, at 4.3% yield. That's 70 basis points above comparable Houston bonds. The market is pricing in risk. However, if Mamdani's policies stabilize working-class communities, tax revenue could increase, improving credit quality. The outcome depends on execution. If you're a worker, 8,400 finance jobs lost means 26,800 secondary service jobs at risk. But Mamdani's supporters note something important. If rent freezes and free childcare work, service sector wages could rise 15% as labor markets tighten. If you're in construction, the question is whether 20,000 new affordable housing units create more jobs than rent freezes eliminate. If you're an investor, Empire State Realty Trust is down 18%, half the loss of competitors. Why? They're signing retail leases with the city for Mamdani's municipal grocery initiative, government-backed income with zero default risk. The contrarian view, municipal dependence could backfire if budget shortfalls force the city to cut programs. Which are you? Because whether you realize it or not, you're one of them. Mamdani's victory isn't just about New York. If his policies succeed, every progressive mayor in America has a tested playbook. Los Angeles, Chicago, Philadelphia, Seattle, all watching. But if foreign investors pull capital, if construction craters, if federal funding cuts trigger crisis, moderates regain democratic control for a generation. The data tells us this. Mamdani takes office January 1st. The Rent Guidelines Board votes in June. Federal funding decisions drop by March. Between now and then, markets will price in every scenario simultaneously. Investors are considering three broad approaches. Some are reducing real estate exposure, accepting smaller losses now to avoid potentially larger ones later. Others are increasing municipal bond positions, betting that Mamdani's pragmatic implementation will succeed. A third group is hedging, allocating to financial sector ETFs while reducing commercial REIT exposure. None of these strategies is inherently right or wrong. Each reflects different assumptions about how the next 18 months will unfold. Tonight, consider reviewing what your retirement fund actually owns. Research shows that approximately 73% of retirement accounts hold some form of real estate investment through index funds. The question isn't whether that exposure is good or bad. It's whether you're aware of it and whether you understand how political transitions in major cities could affect those holdings. Financial literacy starts with knowing what you own. If you enjoyed this video, stay with us for the next one. It is called, What If Helium Disappeared? In that story, a simple party balloon becomes a quiet warning. It shows just how fragile modern medicine is and how delicate our technology has become.